You saved for 30 years, did everything right, contributed to your 401k, rolled it into an IRA, told yourself you'd figure out the taxes later. Well, later is here. Because here's something the brokerage statement doesn't mention and your HR department definitely never brought up. Every time you pull money from that traditional IRA, you're not just paying income tax on that withdrawal. You are mathematically triggering a higher tax on your Social Security check at the same time. 2 taxes, 1 withdrawal, 1 hidden formula that nobody explained to you in 1994 when you signed up for that 401k. I'm Eli, this is 50 cents of advice, and today we're going to make it impossible to surprise you at tax time. Stay with me. This one's worth the next 12 minutes. Let me back up to 1983. Congress was trying to shore up Social Security. Same song, different verse. And they decided that people with higher incomes shouldn't get their full Social Security benefit tax-free. Reasonable enough, so they created what they called combined income. Some places call it provisional income, and built a formula. Here it is. Write this down. Your adjusted gross income, plus any tax-exempt interest you earned, plus 50% of your annual Social Security benefit equals your combined income. That number is the tripwire. Here's how it works. If your combined income is below $25,000 as a single filer, or below $32,000 if you're married, none of your Social Security is taxable. Zero, not a penny. If it's between $25,000 and $34,000 for singles, or $32,000 to $44,000 for married couples, up to 50% of your benefit gets added to your taxable income. If it's above $34,000 for singles, or $44,000 for married couples, up to 85% of your Social Security gets added to your taxable income. Now I want to stop and say something important because this trips people up every single time. 85% is not your tax rate. The government is not taking 85 cents of every dollar of your Social Security. What it means is that 85% of your benefit amount gets counted as taxable income and then gets taxed at whatever bracket you're in. Big difference. Still stings, but let's be accurate. And here's the kicker. Congress never tells you those thresholds, $25,000, $34,000, $32,000, $44,000, have never been adjusted for inflation. Not once. They set them in 1983 and 1993 and left them there. You know what $25,000 bought in 1983? A decent used car and a family vacation. Congress's definition of higher income is quietly swallowing more and more retirees every year. Okay? So now you see the formula. Here's where traditional IRA withdrawals come in, and why this gets expensive fast. Let me give you a real household to look at. Let's call them Frank and Linda, married couple, both 67, Social Security income combined, $36,000 a year. No pension, living pretty well. Frank pulls $30,000 from his traditional IRA to cover some home repairs and a granddaughter's graduation trip. Feels reasonable. Watch what happens to their tax picture. Their AGI is now $30,000 from the IRA withdrawal, plus any other investment income, let's say $4,000, for a total AGI of $34,000. They add their tax-exempt interest, zero in this case, and then add 50% of their Social Security, which is $18,000. Combined income, $52,000. $52,000. That blows right past the $44,000 married threshold. They're now in the 85% zone, which means $30,600 of their Social Security benefit, 85% of $36,000, gets added to their taxable income alongside that $34,000 of other income. Their taxable income just jumped to over $64,000. Before that IRA withdrawal, their taxable income from Social Security was close to zero. After it, they owe income tax on an extra $30,600 that wouldn't have been touched if they'd sequenced this differently. This is what tax professionals call the tax torpedo. 1 withdrawal, 2 tax triggers. Remember staying up late watching those Billy Mays infomercials? But wait, there's more. That's what the IRS does at tax time when you don't know this rule. Except that Billy was selling you something useful. The IRS is just quietly handing you a bill. Now, here's what I want you to hear. This is not a hopeless situation. There are specific strategies that let you reduce and sometimes eliminate this double taxation effect. Let's go through the 3 best ones. I'm not a financial advisor, and this is not financial advice. Everything I share is for educational purposes only. Your situation is specific to you. Please consult a qualified tax professional or financial planner before making any changes to your withdrawal strategy, Roth conversion plan, or charitable giving approach. Roth IRA withdrawals are tax-free, full stop. And this is critical. They are not counted in your provisional income formula. Pulling $30,000 from a Roth doesn't touch your Social Security tax calculation at all. So if you have traditional IRA money you haven't converted yet, and you're in a lower income year right now, you may be sitting in a conversion window that closes when your RMDs kick in at 73. A Roth conversion means you pay income tax now on some of your traditional IRA money, move it into a Roth, and then all future withdrawals from that Roth are tax-free, including zero impact on your Social Security. The best window for this is typically after you stop working, but before you start Social Security, or before your required minimum distributions force income on you at 73. The math on conversions is specific to your bracket and your timeline. What I am telling you is, if no one has talked to you about this window, that is a conversation worth having soon. The second strategy is about sequence, the order in which you pull from different buckets. If you have both a traditional IRA and a Roth IRA, think carefully about which one you tap first and when. Pulling from Roth in years when your other income is already high keeps you from lighting up the Social Security tax formula. Saving traditional IRA withdrawals for years when your other income is lower gives you more control over that provisional income number. The goal is to stay below the top threshold as much as possible, or at least to control when you cross it rather than letting it happen by accident. This isn't about never touching your traditional IRA. You will have RMDs starting at 73, whether you want them or not. It's about being intentional in the years before that clock runs out. Strategy 3 is for the charitable among us. And even if you're only mildly charitable, you might want to become more so once you hear this. If you are age 70 and a half or older, you can make a Qualified Charitable Distribution, a QCD, directly from your IRA to a qualified charity, up to $105,000 per year. Here's the magic. That money goes directly to the charity from the IRA custodian. It never hits your bank account, never appears in your AGI, never touches your provisional income formula. If you were already planning to give money to your church, your grandkids' school, or a cause you care about, doing it through a QCD instead of writing a personal check is almost always smarter. Same generosity, lower tax bill, protected Social Security, and for people who need to take RMDs but don't need the income, a QCD can satisfy your RMD requirement without adding that distribution to your taxable income. That's a big deal. This is one of those rules that feels like it was written for rich people, but actually works perfectly for middle-class retirees who give regularly. If your pastor doesn't know what a QCD is, you can explain it to him now. Here's what I want you to do this week. Not someday, this week. Sit down and calculate your provisional income for last year. Take your AGI off your last tax return. Add any tax-exempt interest, add 50% of the Social Security you received, and write down that number. If you're above $34,000 as a single filer, or above $44,000 married, you are in the 85% zone. If you're close to those lines, even one large IRA withdrawal can push you over. Now look at what's scheduled to come out of your traditional IRA this year, either by choice or by RMD. Ask yourself, is any of that movable to a Roth? Is any of it replaceable with a QCD if you give to charity? Is there a lower income year coming up where a partial conversion makes sense? You don't need to solve all of this today. You need to know your number today. That one calculation changes everything about how you plan the rest of this year's withdrawals. If this one hit different, share it with someone in your life who's starting to draw from an IRA without knowing this rule exists. Could save them thousands. And if you want to go deeper on Roth conversions or figure out when exactly you should start Social Security to keep your combined income in check, that video is right up here. I'm Eli. This is 50 cents of advice because good money sense doesn't have to cost you a fortune.